Welcome into this week's On the Spot. I'm Tony Mulvey, joined on the phone by Kevin Hill. Kevin, how are you doing this morning?
Doing great, Tony. Doing great.
Awesome. Well, this week we've obviously got retailer earnings that have started to roll out. We'll touch on that more, I guess, next week in the research corner. But we'll start really talking about where this market is and where it's headed. And we started to see the contract market kind of roll over. I mean, over the past, really since, I guess, early August, right? I mean, we're looking, granted, we start looking at contract rates, they're 14 days behind. I talked about it with Donnie this week. I mean, earlier today, we're 6% off of that June high. I know you've talked about it. You want to see double-digit contract rate decreases because you like double-digit, but we're really in that range of where we thought double-digit declines. But I mean, this is where we're right kind of in that range of where we thought we might be at this time.
Yeah, if you look at the difference between contract and spot rates, especially excluding fuel, which is kind of the contract to or spot to contract spread that we have, is 83 cents. It is certainly double digits. Spot rates without fuel or excluding fuel has dropped, I think it's 29% right now from its mid-February highs. So you should expect double-digit contract rates to fall or contract rates to fall to double-digit levels by the end of the year. So that's what we're looking at for the second half of the year. We're starting to see it start in mass right now with 6%. Drop, it has a lot more room to run. This is just kind of the initial readings of that.
Yeah, I mean, I think that's the key. We'll pull up the chart real quick to kind of show it over the course of the past year. I mean, you can really see that decline that we see in August, right? It basically, we're back to where we were in February. And I think that's kind of I don't want to say it's a concern. I mean, it should be a concern if you're if you have freight under contract, because, obviously those rates are starting to go down. And to, like you said, kind of anticipate them to continue to go down because there is that room to run compared to the spot market. Now, we'll kind of go ahead.
No, go ahead. No, yeah, there is room to run, and that's what, if you have contracted freight right now, then you should expect a lot more of the conversations with your customers or your vendors, depending on what side of the equation you're on, to really ramp up in the second half of this year. It's been active, but it's going to get more active as we move forward.
Yeah, we'll pull up our next chart here, and it's our van outbound tender rejection index. Right at 6%. You look at it compared to, I think this time in 2019, it was like 3.5%. So we're still above that. In comparison, though, to where we've been the past 2 years, obviously not a good sign. It kind of proves that those contract rates, even with the decline, is still kind of ruling the roost, if you want to say. There's definitely the benefit of being under contract.
Oh, yeah. We reached lows of the spread between spot and contract of 98 cents. Spot rates being 98 cents below contract rates. We're now at 82, 83 cents, I believe. So it's still a historically wide gap, and that's kind of what we're seeing in the tender rejections is that contract rates are rich right now. They're rich. There's no reason to move any assets into the spot market whatsoever. Gobble up all the contract freight you can handle, whether you're a carrier or a broker, because that's where the money is. That's where the steady flow is, and especially if you're a freight broker, that's where the margins are right now with that huge disparity in the spread.
Yeah, and I think if you look at Southern California, Ontario, I think rejections, they dipped below 2% a few, I guess, last week, but they're right at 2%.
There are some markets. Yeah, there's some markets out there like Ontario that were a very hot freight markets over the last 2 years that, it seems like nothing or very few loads are really going from contract to spot. It's minimal at best because of those renegotiated to higher contract rates that we saw right before the collapse in the spot market rates.
Yeah, and fuel has an impact in that. We'll bring up our next chart. It'll be that rates chart that you talked about, that spread between our outbound or our NTIL, so that line haul only rate, and that contract rate. We see it's at 83 cents, but if you draw a line kind of at that zero mark, right? I mean, we're still so far below where we were in 2019, but it's starting to move. It's that gap's narrowing, but it'll be interesting as more data comes in August, right? Because you start looking at contract rates, they're on that 14-day lag. Where, I guess, go ahead.
Well, another interesting point is I had a couple calls this week from people asking and kind of batting around ideas about fuel surcharges because diesel pricing is coming down right now. There's two components really in those contract rates, or any rate, right? You have the line haul and the fuel, and you balance them out to get a price that makes sense for you. And with the volatility in both of those right now, it's hard to do that balancing act. So you're having to forecast really two different things that have been diverging of late, and it makes it very difficult to put in pricing for any more than a few weeks out.
Yeah, absolutely. Well, Kevin, we've got about 30 seconds left. Real quick question. With these inventory gluts that we're seeing from these retailers that are trying to get rid of some of this unwanted inventory, where does the freight market go from here? I mean, where do you think we go the rest of the year?
I think it's going to be a lot like 2019. You see it in the rejection rates. You see it in the spread. You're going to see falling contract rates. You'll probably see a floor in spot rates, maybe a little bounce up here and there. But I think it's going to be a very subdued holiday season, just because I think the mix back to services is happening. A lot of inventory, so the future orders will be low this year.
Awesome. Well, thank you so much for joining me on this week's On the Spot, Kevin. Right now, toss it back over to Kaylee and Michael.